What's up, everybody? Welcome to Bullish Rippers. This is Evan, better known as Stock Market News on Twitter. Every Monday at 9:20 a.m. Eastern and Friday at 4 p.m., myself and my co-host, Wolf_Financial, also known as Gav, put on these spaces to help you guys get ready for the week ahead in the market and then get caught up on the week just past. Our goal is to educate, inform, and hopefully entertain you guys a little bit. We really appreciate you tuning in, and I hope you enjoy. We got like 50 people in here. I see Gav coming up as well. Let me start getting into it. I'm gonna roll through and see if any headlines crossed as we close. I know today definitely did turn with a lot of the more macro headlines. Quickly for the week, I am seeing the S&P 500 was down 1.82%. The Dow Jones was down about 1%, and then the Nasdaq 100 was down about 2.8% this last week. Looking at today, let's see if I can find today's numbers. For today, the Dow Jones was down 1.43%, the Nasdaq was down 2.78%, and the S&P 500 was down 1.9%. So a lot of the downward action in this week did come from today. I'm sure, as a lot of you guys and girls already well know. Gav, do we have you up here, or are we just on the second phone right now? Perfect. I'm going to take that as we're on the second phone. Wolf Financial Account will be up here in a minute. Before we do that, Brad, I want to bring you into this. I know we got a little bit on your intro and hear a little bit about that, but I would love to hear how your week was in the market. Do we have any of your stocks report earnings this week?
Yeah, so we had just one. So JFrog, which is the continuous software management company, and then specifically within DevOps, they're focused on binaries. Well, a lot of these other companies that they are more so partnered with and more so complements of focus on source code. But for the actual quarter, everything looked pretty darn good. It's still, I mean, it's a hyper growth company. You're not really a hyper growth company. It's a 35% grower that isn't GAAP profitable, isn't GAAP net income profitable. So in this environment, kind of out of favor, as we talked about a little while ago, as macroeconomic, as the macroeconomic backdrop of everyone fearing balance sheet runoff, which kind of has to happen because the balance sheet is massive, and the federal funds rate going up, which kind of has to happen because it's at zero and not super healthy as we cycle through economic cycles. I guess for using two words in the same sentence, but yeah. So from the quarter specifically, just pulling up some of the numbers here real quick. Gross profit margin for the year expanded 160 basis points to 84.2%. Free cash flow margin is solidly in the 20% range, and I haven't been able to pull this up yet, so just give me like 20 seconds and then all right, here we go. So the company was supposed to generate 58 million in revenue, beat that by 2%, raised its 2022 demand outlook by another 2%. Clients with ARR over 100,000, which is really a key performance indicator for them, along with trailing 12-month net dollar retention rate, because it shows how much traction they're gaining with their existing client base. And that growth for both of those metrics accelerated. Trailing 12-month net dollar retention rate had actually been receding for the last 2 years, and it went from 129% to 130% sequentially. So not a massive spike up. It's now gone from 140 to 130 over the last 2 years, but really nice to see that reversal. And if they can stay at 130, like they've been telling us they're going to stay at 130 in the years to come, there's a lot to like there. But from a revenue growth perspective, 39% was the fastest growth rate they've put up in over a year. And they really attributed this to an improving business environment. And then also they've really leaned into building out their enterprise sales team over the last 12 months. So they've definitely, the way to describe their go-to-market has been very much so grassroots. They start with developers and then they work their way up the chain to enterprises. And they're starting to turn that on their head now that they have this very solid base of Fortune 500 clients in place. They're hiring a lot more sales reps. They doubled the size of their workforce to over 1,000 this year, and that was mainly in the enterprise sales and also R&D departments. But they're really leaning into these enterprise sales clients, which is leading to this acceleration in large client growth and this acceleration in retention rates. So outlook, I think I went over that a little bit, but very much so in line from an operating income and net income perspective. Again, a little bit of a raise from a demand point of view. And then, so implied forward valuation, assuming a 20.6% or 20.6% 2022 free cash flow margin, which basically assumes no expansion at all. And it probably will expand a little bit or based on management commentary, but just to be conservative and keep it at 20.6%. And then they've also raised their revenue outlook every single quarter since they've been public, but also let's just assume that it's at 274, that midpoint like they've set. So with all these probably slightly conservative assumptions, it trades for about 38 times free cash flow and about 7.9, 8.0 times sales. So it's supposed to grow at around 30% for 2022. So it's one of these software as a service companies that the model is beloved by the FinTwit community, and rightfully so. Everything is extremely visible. Everything is extremely recurring. But it hasn't gotten or hasn't garnered a lot of attention, hasn't garnered a lot of hype, just because I mean it is a complicated company to understand. It took me a very long time to really hone in on what they do. And yeah, a few more notes from the call to bring up. So this Log4j software pandemic that we had, software pandemics in quotes because that's what the developer community had been calling it, but this Log4j error, and it was really the source of the problem. Was very much so binary focused. So what had to happen was developer teams, and this was during Christmas and New Year, so you can imagine these developer teams were not super happy for being in the office or even working remotely. They had to manually go through millions and millions and millions of binaries, and many are still working on it right now. So it took massive teams, weeks and weeks and weeks, to manually go through which binaries were impacted by this Log4j error and where dependencies lied within companies' software stack. So they had to do this all manually, extremely labor intensive. But with JFrog, their end-to-end DevOps product was able to automatically patch this error and patch all the dependencies that this error was leading to within its clients software databases, and that happened within a matter of minutes, not within a matter of weeks. So Log4j has been, I shouldn't say was because it's not over. There are still many companies dealing with it, but it has been essentially a free marketing campaign for JFrog to demonstrate its value proposition and to demonstrate how it frees companies to focus on the quality of their software packages and not on the maintenance or the security or the storage of these software packages. So pretty positive quarter across the board. They're not one of these companies that will post 20% top line beats and then miss by 10% the next quarter. It has been, and I say this with a grain of salt because they've only had 5 quarters of being a public company, but it's generally 2 to 3% top line beats and then another 2 to 3% top line raise, and that's exactly what we saw. That's exactly what we saw this quarter. So pretty much in line in a lot of places, and then you look at about a 38 times free cash flow multiple and a 28% free cash flow margin and 30% growth with high 20s with about 28 29% growth expected in 2023 and 2024. And this is morphed from being ridiculously expensive when it went public. I think it was at like 40-50 times sales to now sub 40-50 times free cash flow. So and with 4 quarters that have generally outperformed across the board, 5 quarters, sorry. So a lot to like here. I think I'm obviously extremely biased because I own shares in the company, and I actually have in the past few weeks. I didn't add today, even though I thought the quarter was good, and it kind of underperformed. But I don't really care about that on a day-to-day basis. And yeah, all of that is just to say, long story short.
Oh no.
So
Brad, it is still having some connectivity issues. So listen, wait, Brad. Let's try and get you back in here. We'll get you down and get you back up. That tends to help with a lot of these problems. And we'll get you right back.
Maybe you just need to get off the Wi-Fi.
Wishful thinking. A lot of times it is Wi-Fi. Whatever we got to do, Brad. I'll get you right back in here. We'll go to you. But I think this is a good opportunity to kind of bring in the 2 speakers that have joined in, co-host and speaker, we shall say. Markets. Oh my God, market mayhem. I almost said market rebellion there. Jesus, that I don't mean to disrespect you with that in any way. I know that's new. That's a new. So market
Hey,
mayhem,
you're good.
I've been loving a lot of the spaces you've been doing as well. Great Twitter account.
Thank you.
Excited to get you on more of these in the future. But yeah, would love to kind of hear a quick intro into how your week was in the market. And I did see a couple of your voice notes from today. So maybe if we want to, I know there was a couple of them, so it's a lot of thoughts there, but maybe some of your initial thoughts up there as well.
Sure. Yeah, happy to do that. And thanks for having me on. And, hope everyone out there had a good week. I know it was a difficult week for many, especially if you're swing trading or investing in this market. For me, a lot of the stuff that I'm moving around on a week like this is day trading positions. I still have my swing trades and my investments kind of set up as they were. I have some put spreads in my investments. My swing trades are in constructive uptrends, and my day trades are mostly in the S&P 500 and some of these individual shares. So to walk you through what a week like this looks like for me, I'm trying to basically on the S&P 500 trade around the opening range. Breakouts usually lead to positive trend days, so I'm more constructive. Breakdowns like today usually lead to declines, although not typically this steep, but we had some event catalysts leading into this both yesterday and today. And then, inside days, they're a little bit more choppy, and sometimes there's less opportunity in those inside days. So today was a downtrend day. We broke below the opening range, and that gave me a signal to put on a short, which I rode, just before the close. I saw it kind of start to break below 4,400. It looks like a pretty good supply zone. So I started to put some buy orders in and close out of that short. That was most of my trade for today. Yesterday was a little bit more exciting. I was fading Affirm and ASTR because it looked like they really were running up. Affirm was running up starting on Wednesday on Delta-driven squeeze action. A lot of close to the money, near dated call buying. That was driving shares up. And then they had that sort of accidental oopsie moment on Twitter. But as soon as the news broke over the wire that their earnings were out during regular trading hours and it looked like it was a miss, I started to pile into some puts on Affirm. And then ASTR looked like it was a kind of buy the rumor, sell the news event. As the rocket launch happened, we saw premiums start to flood out of their calls, and that was my signal to get short some shares. So, playing things one day at a time. For my day trading account, I'm flat at the end of the day. I don't have any positions I run overnight. In my swing trading account, I have things like agriculture exposure through futures to corn, wheat, soy, rough rice, and a couple others there like oats. And then I also have some exposure to Latin America, primarily Brazil small caps. I have a little bit of exposure to Asia through Singapore ETF. And that's kind of how I'm playing my swings. Very simple, just looking for smooth, constructive uptrends that I'm riding for 2022 so far. Some of these things I've had on and off since mid-2021, like agriculture. If you look at, for example, the DBA ETF, that's a good way for home gamers to get exposure to agriculture. That's up almost 50% since summer. So it's handily outperformed the U.S. markets, and it's a more constructive, more stable uptrend. There's less volatility. There's less people just kind of panicking in and out of it. And then, just commentary on the market to kind of talk about my voice note and what I'm seeing out there is that, we have a market that was myopically focused on the Fed going into the volatility that we had that led us down to that sort of low that we had in late January to about 42.1275 on S&P March futures. And then we had this nice little rebound because the selling was a bit, it got a little bit exhausted. We got oversold on just about every metric, whether you're talking about sentiment, whether you're talking about breadth, whether you're talking about some of the strength or other kind of oscillators. So there was some room for this reflexive rally. And then we rallied right into earnings, and we had better than expected earnings from a lot of these major companies that really, in many ways, technically saved the market. I think in particular, Microsoft and Amazon were kind of putting in good earnings at times when the market was very, very precarious from a technical standpoint and could have really rolled over if we had the other side of that possibility. If they missed and the market wasn't very happy, that could have taken us much lower. But nevertheless, the market tends to focus on what's in front of it, and earnings are not really going to be in front of it. In fact, we started to see the market really start to myopically focus again on the narrative by the Fed. Yesterday, Bullard came out and he was very hawkish. We had hot CPI data, and then we had a very poor 30-year auction that, Bullard went pretty much front ran. He gave a lot of reasons not to buy U.S. sovereign duration right before there was a $23 billion auction. So it didn't go so hot. That hurt sentiment, and we saw selling intensify. And then, of course, we had today where, we have on the one side the increasing macro risk of the Fed, and how they're draining liquidity out, and that sort of rising tide that lifted all boats is going the other way now. We're going to a lower tide, and we're going to see how many people were out there swimming naked, I think, because if liquidity continues to leave the system, a lot of companies are going to be in deep trouble. Refinancing costs are going to go up if you're not making money on the bottom line. line. You might have to dilute your shareholders or take other measures that aren't advantageous. So, that's something that's being priced in. I think we're seeing more of the pricing into the risk from the Fed in the bond market than we have in the equity market. I think the equity market's just starting to catch up to that reality as it was in January. It was a little distracted by some of those earnings. And that's not to say that earnings aren't a good driver. In fact, during tightening cycles, the companies that earn well from a bottom line profitability and free cash flow standpoint tend to be the companies that outperform versus an environment with rising liquidity where you have pretty much, rising tide lifts all boats, and those good earners tend to outperform. So it's something that we have to keep an eye on. We're definitely late cycle here, and we do have already an overabundance of institutional allocation to some of those late cyclicals like energy, financials, industrials, and materials. So there's not as many opportunities in that space as there was. And today we started to see that bid come into those very end cycle types of defensive plays, those low volatility large caps. So, between that, the heightening geopolitical risks that put a bid in for safe havens like gold, volatility products, U.S. dollars, and some of these other safe haven assets today, I think that the mood has become more risk off. I think if you look at the S&P just over like a weekly view, you can kind of see that we've put in this head and shoulders pattern. We've kind of closed below. We were able to fill that gap that we had to the upside, now back to the downside. And technically speaking, we're at some realistic level of risk that we could retest those January lows, which at this point are only 200 handles below where we're trading right now. So it's not a far-fetched possibility that those lows could be retested in the next couple of weeks. So I think, for me, I'm taking smaller position sizes, shorter time frames in my day trading account. Like I said, I'm closing out that on a daily time frame. For my swings, they're still in constructive uptrends. If that changes, I'm out. And in my investment account, I'm continuing to, buy insurance in the form of puts or put spreads, depending on the distribution of volatility and, whether it makes sense to go in with just a put or to have that spread in to decrease the debit.
Wow, a lot of great, fantastic information there. That is exactly why I wanted to have you come on this Spaces Market to Mayhem. Super excited to dig a little bit more into those thoughts. I also, after this, I want to make sure we get back to Brad and bring Gob into this. But I do definitely want to talk about that tweet that you sent out last night. That I think it's changed a little bit since then. But last night, the Fed futures were pointing to a 99% chance of a 50-point interest rate hike in the March meeting. So that will definitely be interesting. I would like to maybe see where that is at and dig a little bit more into that. Excited for that. As we're speaking and as these fantastic, amazing speakers are speaking up here, I said that way too many times. I'm not going to repeat it one more. Make sure you're clicking to their profiles, checking them out, check out what they're doing. They are all fantastic speakers, really informational and very knowledgeable. So, it's really difficult to come up onto these spaces and just be able to talk and really get your mindset out. And you can really hear who is smart and who isn't and who knows what they're talking about. So, make sure when they're speaking out here and they're giving really great knowledge that you click into their profiles and hit that follow button. You will not regret it. But with that, enough blabbering. Gav, I will bring it back to you in a minute. I wanted to make sure we let Brad finish up his point because he got into.
I was pretty much done talking.
It was pretty much about 20, 30 seconds before then at that point. So we can come back to you a little bit on that one after.
Yeah, I think maybe the last
talk about some of the other names too.
Just the last point. I think if my memory serves me correctly, the last point was the company's gone basically from 40 times sales to sub 40 times free cash flow in the matter of since its IPO and since the peak shortly after its IPO. And during that time, it's posted 5 really great quarters. So to me, this is the cliche that I always use: broken stock, healthy company. And the multiples have compressed to a point of being very attractive now. So I've been adding aggressively the last few weeks and probably will continue to do so. So I think that was the last point I was trying to make. And then as always, I could be wrong about the company and do your own research and blah blah blah. And yeah, so we could probably pass it on to Gab now.
Perfect. Do we have any good Substack write-ups on JFrog?
Yeah, it's in the it's up. It's probably coming in May or June. So I have to get one out on PayPal and Match Group and then SoFi first, and then that's the next planned one. But I mean, in terms of investor conferences and earnings reviews and basically every time their CEO makes a public comment, all those notes are definitely in the Substack. If you go to the link and just Control F or just search within Substack for JFrog, it'll take you there.
Awesome. Yeah, definitely a great free Substack to check out. Brad is a really smart guy, fantastic writer. So click his profile, check him out. But I will keep us moving. It's been 23 minutes, and we've heard one or two funny quips in there from my co-host, but we haven't really gotten a chance to hear from you, Gav. We'd love to hear you how your week in the market was. I'm having trouble with words today, damn. But yeah, how your week was in the market, how you feeling about everything, and any other interest stuff you want to say.
Well, I was feeling better about this market, a day or two ago. I was feeling pretty good in my portfolio. I've been having a nice week. I was up about 8% on the week, maybe a little less, 7%, 7.5%. Closing out the week now at 2.2%. Could have probably came in on a couple of better hedges today, but to be honest, I've not been making a massive amount of moves in the market. To me, overall, right now, my focus is just making sure that the scalps and the day trades and the option trading that I'm doing is a little bit more accurate. I want to be making sure that those are positive investments, and that's what I did. The only trade I placed this week was live with exclusive on Thursday. I bought Apple calls in the morning, bought them at 90 cents, sold them literally a couple minutes later at $1.07. Flipped them. It was like a quick 18-19%. Boom, in, out, made some money off of that, and got out. So I was pretty happy, to be honest, that the only trade I did this week came out positive. There were a couple other trades I did wish I took, specifically Tesla puts today. I had a lot of people that were talking to me around 1 p.m. We were talking Tesla with the chart, and when it broke down through the 880 level, that's where I really should have come in with some size on these puts. I watched them go from about $1,000 a contract all the way up to $3,000 per contract. So that was a pretty nice run, and you know what? I'm not too worried. Like, I had it on the watch list. I watched as it went, and I don't feel too much FOMO. Like, yeah, it would have been great. To be honest, I probably would have gotten out much sooner before that move. Like, that's one of the biggest things I realized with the trading is not to worry about, oh, what would happen after the move, because I know at this point I'm getting out 10, 20, 30%, maybe leaving a couple runners, but it's not like I missed out on a giant move, because that's not what I'm sitting in this market to do. A little bit concerning seeing SPY close below the 200 day. Was talking about this on Spaces earlier as well, but now SPY is down to 441.08 in after hours. It did close below the 200 day, as well as the anchored VWAP from recent lows, the year-to-date anchored VWAP. It wasn't able to hold any of that, and it's kind of sitting on this volume ledge. If SPY drops underneath 429, that's kind of the next level that I'm looking at, 429. I'm not so happy with what's happening there, and I'm a little bit curious because it seems like it's all event driven right now. So we just spoke about how with Putin and war and all this, who knows what's going to happen and which way it's going to go. Is war good for the economy? Is it bad? Is the news bad? Do people just freak out too much? To be honest, I'm not sure. I think it's a very much a wait and see. So still holding on to my long-term portfolio. I think a lot of those names have come way down. Names like SE and not Apple, I think that's still pretty high up there, but Palantir and CLH and Square and Etsy, a couple other names that are in there as well. So I haven't really added too much to any of them. I'm kind of just waiting for a clear direction within this market. And then I do have cash. So cash is a position. We've said it many times today. It's not a great long-term position, but it certainly doesn't hurt in the short term when there's market volatility. So just waiting to see, but I'm ready to deploy it, and specifically probably on some of these shorter term option trades. So I'm excited to go into next week. I have a bunch of day trading spaces in the mornings, at least 2 or 3 of them, I think, planned for next week, and just be talking with people live. And it's definitely come down to much more quantity than quality. I think I had this urge to place a trade every single day for a while, and luckily that has subsided. And you know what? I did one trade last week. It was a green trade. Good week in my mind. And we'll kind of go from there. So that's overall how things are going. Also moved a lot more money into crypto staking. Again, I'm staking on Anchor Protocol. I went through on a space how to do it. You can make 19.5% off staking a stable coin, which means the asset itself doesn't really have downside or upside potential. It's just staked to the US dollar at $1 per, but you can earn 19.5% per year on there. So right now at 19.5%, I don't really see a ton of assets that are beating that for a long-term portfolio. So that's where I am moving more money, and just always seeking out opportunity, dabbling within NFTs, maybe a little bit more. But just kind of catch me with a diversified portfolio and maybe some real estate with Lex. Who knows? kind of just throwing a little bit of something, everything in there. But yeah, thanks for the time, Evan. Great chatting on here. And if anybody hasn't already, we're in the thick of earnings season. And when it's earnings season, you need to have information fast. You need to be reliable sources. And there's nobody who's faster and more reliable than stock market news. So click in his timeline, take a scroll. You'll see all the incredible information that he's putting out there and how much he is definitely worth your follow. That's all I got for now on my recap for the week. Back to you, Evan.
I appreciate that, Goff. As always, thank you, man, and also a fantastic follow. I'm going to say this a couple times up here. Get used to it. All our speakers up here are amazing. Make sure you're checking them out. Posted some really fantastic content. You mentioned a little bit about cash there, and as you said, in an inflation environment, you have to be invested. But cash is still optionality. Well, you don't necessarily have to be. There's a lot of different strategies for it, but cash is very important and optionality. And for the long-term investor, I always like to have at least some bit of cash on the sidelines so that when I see opportunities, when I see something out there, I have the dry powder to go and attack it and capitalize on that. I know, Brad, you also have an interesting strategy with what you do with your free cash, and you put it into an instrument where, it's not keeping up with inflation at these levels, but at least it's better than nothing. I kind of want to ask a little bit about what you do with your we're going to call it cash, but you know what I'm talking about.
Yeah. So for me, I'm keeping it in really highly rated corporate bond ETFs. So it owns JP Morgan debt and Apple debt and just AAA rated corporate bond ETFs. And it's not a long-term position. It's just to generate something besides 0.00 basis points of yield while I have my cash position and while I'm waiting for these opportunities you're talking about to take advantage of better risk reward. So it's not, that crypto staking 19.5%. I think I have to learn more about that because it's definitely not 19.5%. It's just a few basis points of yield, but it's better than nothing. And it is extremely safe. So to me, it's just a slightly better vehicle to keep cash than cash specifically. But it's highly liquid and I consider it a cash position to deploy into other deploy into other positions. So that's how I handle it.
Do you just buy these through your brokerage? Is it like a specific ticker? Like I know 20-year bonds is like TLT, and there's a couple stuff like that. Are there tickers for this stuff?
Yeah, and I am not by my computer, but I'll go through my phone. Yeah, there are so many of them. If you just go into any broker and go like short term, very very short dated, ideally in this macro environment we're in, but yeah, for me it is. Sorry, it's taking me a while to find the ticker. SPSB, but there are a ton of different vehicles that have very similar holdings. And honestly, I'd love to hear from Markets and Mayhem for Markets. I'm sorry, I got that backwards. To see what he thinks about that philosophy, because he's very in tune with portfolio building and macro and all those things. And I'm more so micro focused.
I
Sure.
will say the at and the name are the exact opposite. So I think both were right there actually.
I just call him Mayhem.
Yeah, Mayhem's great.
Commercial.
Yep, that's fine. And it's appropriate for where we are in the market. So, I like muni bonds a lot here, honestly. If you can get exposure to tax-free muni bonds, you might have some advantageous yield harvesting. I wouldn't necessarily go all in a interest rate rising environment to any kind of fixed income, but you might see opportunities that get increasingly attractive as the Fed looks at, tightening more and more. Because what they're doing is going to take some of the liquidity out of these products for certain in the short to intermediate term, but it might also provide some attractive allocation opportunities. So, that's an area that I had parked some money in 2020, and then I gotten out of, to start getting into some of these stocks that were really getting attractive. But, if we have another kind of like route in fixed income and things look kind of bad for maybe a couple months to years, that's a great area to hide, especially in muni bonds, because you get tax-free yields. And it really does depend on where you live. You don't want to do it somewhere where your government's on the verge of default, where they don't have a good balance sheet, where they're not going to be able to repay their debt and your munis are going to go down. But if you live somewhere where, they have triple B or higher rated debt and you're comfortable with the risk and you like the yield and you're getting it tax free, that can be a pretty attractive place to go, just full well knowing that tightening can have a deleterious impact on the pricing of bonds.
Yeah, just some additional context from I live in Detroit, so in terms of balance sheets, not the best, not the worst anymore. It's getting better, but definitely appreciate your insight and color there.
Yeah, absolutely. I mean, the other thing that gets more attractive in this type of environment is probably short-term treasuries. The rates are starting to go up on those, and so that's an area. I mean, look at the 2-year, just where it's gone in the last couple of days. It's now at like 1.48%, but yesterday it was over 1.6%, and that's something that's pretty interesting given the flattening of the yield curve. So that's an area where I'd be just poking around and maybe looking for some opportunities to start edging in. And like Brad said, it all does depend on where you live. And, if you're somewhere where you'd be concerned about repayability, you definitely don't want to go into munis. You want to be looking at other opportunities. And, corporate debt, some of these healthy companies, they're going to be fine. Their corporate debt might take a haircut, but ultimately they're going to be repayable. And so if you're, riding it to the maturity of the coupon, if you're actually buying the individual bonds, you should be 100% fine. ETFs, you can get a little bit more noise, but, longer term, assuming that liquidity comes back in, people should be fine. The yield should make up for it over time too. So there's a lot of opportunities out there to hide your cash. Just the shorter, like for me, if I'm really looking at just very short-term parking cash, I just like very, very short-term treasuries. That's one of the safer parts of the markets. And that's one of the areas where you kind of see the Fed coming through and doing those reverse repos because there's so much demand for this stuff that they could potentially go negative in rates. And the Fed does not want a negative rate liquidity trap. So they drain a lot of that liquidity out of the system. But that's a pretty safe part of the market to park cash in. You're not going to get a lot of yield, but you're also not going to lose your money.
Mayhem, I want to shift the conversation a little bit, but keep it with you. So I brought up in my intro earlier that what you tweeted out last night, that the futures were pointing to a 99% chance that we were going to have a 50 basis point rate hike in March. Jesus, this is a rough speaking day. But yeah, and I just saw the one that you put out, another tweet that you just put out, that now it is about 50-50 if it's going to be 50 point or 25 interest rate hike in March. So I just kind of want to ask a little bit behind that. It's only been like 12, 16 hours. Like,
Yeah.
is that type of shift just the market environment we're in now, and all these data have to kind of be taken with a huge grain of salt, that it's like where we're at this second projecting forward, or did we really kind of have that huge change in there? Is that from the Russia data and everything like that came out? Do we think, at least, obviously speculating?
Yeah. Well, I mean, I think your first question, is that the market we're in now? Yes, that is very much the market we're in now, where expectations can shift by the second, by the minute, by the hour, by the day. And I do think that increasing geopolitical risk is a factor to consider. I mean, war is good for parts of the economy, but in this type of situation with supply chain constraints and inflation concerns, I don't think war would be a very good thing for anyone. I think it would actually exacerbate a lot of those issues, especially if we see this kind of ramp up tensions in other areas, as sometimes these conflicts can. So, I think that that's part of it. But on the other side of it, this sort of risk and the escalation that's going on has been building up for a while. It's just that, like we were talking about earlier, the market's kind of myopic. It was looking at earnings so closely that it was kind of ignoring a lot of the risk. It was very realistically building up in Ukraine and Russia. Like, the stuff that's going on today is not really new news. It's just further escalation of an existing situation that's gotten increasingly tense. So I think that was a rapid repricing. I think that with Fed funds futures, they're much more volatile than they typically are, because it's really anyone's guess. And we also, outside of Russia, had Barker coming out last night, basically in the after hours session, saying, hey, look, I need to be convinced of a 50 basis point hike. I'm not just going to do it because, other people are saying it, that they would really need to actually be pulled into that idea. So it seems like there's already a little bit of dissent potentially. And Bullard is the perennial hawk on the board. He's one of the more hawkish members. He is a voting member this year, so he definitely matters. We can't just relegate him to obscurity and ignore him like we did in 2021. This year he can actually make a difference in policy. So, on the one hand, he's probably putting out the most hawkish view that we've heard about what they want to do. But on the other hand, we're seeing other members not necessarily gravitate towards that shock and awe 50 basis point rate hike and commencing runoff of the balance sheet aggressively and all that. So we kind of have to see how things play with macro. And I think that the Fed is very good at floating trial balloons to impact sentiment. And they do it both directly through speakers talking and then also through some publications like Wall Street Journal will have like interviews with unnamed Fed officials. And then all of a sudden they're talking about what they might do next and seeing how the market receives it. And I think that is in effect two things. First, they're trying to gauge what is the reaction. Are we going too far? Kind of how does this hit sentiment? But also they can pull forward certain policy outcomes because when the Fed is doing any kind of policy change, whether it's adding liquidity or removing liquidity, the transmission and removal mechanism is through financial markets. And that has a buffer effect. It actually takes 1 to 3 months to really impact the markets fully, to fully realize any policy change. And then it can also take, somewhere between 6 and 18 months to have a real world economic impact. But if you can change sentiment in the here and now towards risk assets, towards fixed income instruments, towards the real estate market, and then all the risk taking that's going on here, all the sort of leverage that's going on here, you can get people to pause and slow down a little bit just by making sentiment less ideal, by making people more uncertain about the future. That can pull forward some of those impacts in terms of appreciating the cost of capital, slowing down bank lending, and even having some real world impact on beginning to slow down the economy. So I think that's one of the things that they're trying to do and why they've pivoted to be decidedly more hawkish, not only because of inflationary pressure and increasing political pressure, which is a result thereof, but also saying that they have to be a little bit more expeditious, that the circumstances are maybe exigent enough in their view that they want to try to do everything they can, even if it maybe has some impact on their reputation, on their credibility in the short term. So that's part of it. And the other part of it is that they probably realize they can't really do all the things that they've said because the inflation situation is one where they have many levers that they can pull, right? They can pull the lever to appreciate the cost of capital. They can pull the lever to pull liquidity out of the system. They're kind of very similar policy effects, raising rates, doing QT, right? But they can't really pull a lever to fix supply chain structural deficits. You can't print new copper into thin air. You can't print new crude. You can't print new coffee. All these commodities have issues, and that's why they're appreciating in value between the amount of supply that's available, how fast they can be produced, and how quickly they can be distributed. And so, the Fed can only resolve for slowing down the economy and appreciating the cost of capital. And that's not even necessarily evenly distributed because if you look at the supply chain, there are components of it that are leveraged up where their balance sheets aren't clean. They have debt. It might be expensive debt that becomes more expensive as that liquidity tightens and as rates are rising. And then they have to pass those increased costs down the supply chain as well. So this isn't a magical elixir that the Fed can do. They can only really slow demand, slow the economy. And, some of these things have to be resolved in other ways. And, we've had problems with government policy becoming an exacerbator of inflationary pressure as well. And, if you're not letting transportation workers come over the border, if they're not vaccinated, that's a problem because now goods aren't being transported. And on the other side of it, if you want to have a big spending bill at the tail end of a economic cycle where inflation is really a problem, and that spending bill is going to increase demand, then that's not really going to help the Fed with their mission. So I think that's another reason why they're so kind of aggressive in the here and now is they're just trying to do as much as they can to pull that policy outcome forward to reduce speculation in the market. And I mean, boy, has it. Look at the most speculative sectors since they really got aggressive. We've seen 40, 50, 60, 70% haircuts in some of these stocks since November. And I think that speaks to kind of where we are. And then also the Fed reaction to Omicron. They just kind of shrugged it off. They're like, it's not really going to hurt the economy. And a lot of people, I think, thought that Omicron would be something that would give the Fed pause, and it really hasn't. And the real world economic impacts have not been so far that bad as prior iterations of COVID. And I think that's because the world's getting better, especially in more advanced countries at dealing with these outbreaks. And this was also apparently a less virulent strain, even though it's more infectious. So, it's kind of like a lot of the catalysts that would have put the Fed at bay have gone to the wayside. And then we have pressure from their dual mandate and from politics and otherwise for them to fight the battle against inflation, even if it's doing it with one hand kind of tied behind their back, because you also have a debt supercycle that they cannot collapse lest it cause a much bigger problem. And that is to say, and I'll cap it here, that cyclical inflation is an issue in the here and now, But secular deflation longer term is a much bigger issue. And that's one reason that they can never fully normalize their policy, in my opinion.
Wow, that was pretty fantastic. That was great there. I had one or two questions as you were going, and then you just ended there with a whole new can of worms that I do want to dig into. I'll hit you with one of the earlier questions as you were speaking. A lot of what I really felt you were getting to, and I forgot who was saying it. Who was saying it earlier? It might have been Matt from Traders Paradise. That what the Fed and comes out and they do is important, of course. But if the Fed comes out and says we're going to do a 50 basis point rate hike, and then Jerome Powell comes on and really walks it all back and does the sentiment and really tries to put the market at ease with whatever he does, is really going to drive the market in what is more important in the short term for the markets. And you kind of hit it on the head a little bit there when you were talking about, that you really kind of look at the sentiment can really drive the changes now, that the actual physical changes of moving the interest rates up will actually, take a while to go through the economy. So, I kind of want to ask you, like, just in general, does that shape you up when you are listening to, what everyone's predicting and everything? Do you ever get to the point where I don't know how much it matters. It's just really what Jerome Powell comes in and presents the Fed is thinking. And my mindset with that is maybe the best place to kind of make your mindset is what the Fed speakers are saying, as opposed to what the numbers are coming out. Obviously, you have to put the bias on who's historically hawkish and who's historically dovish. But I feel like that might be the best way. Obviously, there's no great way or no perfect way, because that'd be too easy. And if that ever did happen, it would get solved and quickly found out very quickly. But said that twice. But yeah, just in general, are you really kind of waiting to hear more about what Jerome Powell specifically says? And yeah, I had a couple questions in there. That wasn't one of my better ones, but I hope you got it there.
Sure. Yeah. I mean, I think the really overarching theme here of what you're asking is kind of how do we manage our expectations about what the Fed's going to do versus what they say they're going to do, although both things matter a great deal. I think that the first thing to do in that situation, if one is really interested, is to read their minutes when they come out and read their policy statements and pay attention to the speakers and get senses for patterns. Certain members of the Board of Governors of the FOMC are going to be more hawkish, and it's going to really matter if they're voting members as to whether or not they're expressing that desire to be more hawkish, because most of the time in the minutes they're kind of consistent. They're going to advocate for that more hawkish tilt. The ones that are more dovish, you want to watch them too, and we do have kind of a even breakout. But what we saw in the last minutes was that there was full consensus for doing at least 4 rate hikes and running off the balance sheet. There wasn't really any dissent, and I think that that's interesting because that's a departure from what we had saw during previous meetings minutes. So I'm very curious. We have the minutes from the January meeting coming out next week on Wednesday, I think at 2 p.m. So I'm going to be very interested to digest those minutes and, of course, listen to other speakers. But I do think this is a Fed that's not bluffing about some of what they're saying. It's just the extent of it is really the question. I mean, I think they are definitely going to tighten to one degree or another in March, unless there's some major, really catastrophic reason not to, because they've really telegraphed this is where we're going to do our beginning of tightening. This is where we're going to formally end our quantitative easing. This is kind of the real beginning of cutting off the spigot, and then maybe eventually kind of draining the liquidity later on. What I have as a question is not as much the rate hike, because 25 to 50 bips, that's going to be digested in a matter of days, I think. What I'm really curious about is the trajectory of rate hikes that they're going to talk about. And I'm also curious about the method in which they're going to perform quantitative tightening, what time scale, how much, and how confident they are, and whether there's any dissent about that idea. Because in the January meeting, it sounded like their policy statement was a little bit more dovish than the speaker's consensus was going into that. There was a lot of very hawkish talk going into the January meeting, and I think there was some sense of relief that the policy statement itself came out as a little bit more dovish sounding overall, even though the minutes were pretty much uniformly, in favor of doing more aggressive measures from December. January kind of sounded like, we're a little more wishy-washy on some of that stuff. And then Powell came out and he said inflation like 20 times, which was a departure for him. He expressed little concern for the economy, for Omicron, for the labor force participation rate, which were things he'd kind of hang his dovish hat on. He seemed much more hawkish. So and usually it was the policy statement that was playing bad cop and he'd play good cop and walk it back. So I'm not sure we're going to see that dichotomy come back where he's going to kind of good cop walk things back unless there's a big reason to do that if the reaction's like really, really, really bad. But right now, I think the Fed is really trying to lean more towards at least the idea of changing sentiment in the market to be more risk off, to bring back the mantra, don't fight the Fed, and to at least try to get some of the froth out of the market and out of commodities and out of real estate and otherwise, because if they aren't able to accomplish that, we're probably not terribly far from the economy slowing down and, God forbid, maybe even having a recession at some point. And so, they have to also kind of create the perception that they're shoring up ammo. And in order to do that, they have to raise rates. They have to kind of take some stuff off their balance sheet. I mean, the perception matters a lot with the Fed just as much as the real world policy outcomes. So I feel like what we have to kind of watch is macro data is going to be very important. The Fed's favorite measure of inflation is PCE, which usually comes out end of month. So I think we're going to want to watch that. I think we're going to want to watch econometrics. We had consumer sentiment come out today. It's the lowest reading we've had in over a decade. And that reading was implying that people were very, very, very dissuaded from participating in the economy because of inflation. They didn't, they're not able to participate to the extent that they want. And the problem is that you can look at retail sales data and it's just sort of a nominal figure. If you look at real retail sales, when you factor out inflation on cost of goods purchased, cost of services purchased, any of that stuff is going to look a lot better in a nominal sense than a real sense because inflation is jacking up the cost. So people are buying less with more money. And so these numbers don't necessarily give us the same feedback if we don't factor for inflation. But the Fed sees this stuff and they're certainly not thrilled to see the consumer, who's 2/3 of the US economy, saying we don't want to participate as much because things cost too much money.
Yeah, we're definitely in a very, very interesting predicament right now and situation. And, who knows how it's going to play out. There was definitely a theme going on, as you said in there, that, the Fed minutes would come out, we would hear how it was, and the market would overreact. And then Jerome Powell would come back and walk us back and bring us back to it. It was interesting to see on the last call that it felt like that the last FOMC call, whenever Jerome Powell spoke, it felt like that really didn't happen. It kind of felt a little bit like the opposite. So, you kind of touched on it there and what we think going forward. But
one thing, if I might though, one thing to clarify is that the policy statement and the presser are different than the minutes. So the minutes come out later. We're going to get the January minutes next week, and that's going to tell us what they were actually talking about in the board meeting with more detail. And so that's like a nice thing to at least be able to take a look at. You get more clarity. It comes out, almost a month after the meeting actually happened, but it's something the market tries to kind of take in to get a sense as to what's the sentiment at the Fed, what's the level of consensus for their policy, how aggressive are they going to be. And it's usually a market moving event. So you can expect some volatility around the release of those minutes and usually through the end of that day.
I wonder why they wait so long, wait a month. Is there any kind of reasoning that we know behind that, or is it just kind of the world we live in?
It's just kind of the world we live in. I mean, quite frankly, in some parts of the government, you're lucky to get anything within like the same year. So, getting it within a month isn't terrible, all things considered.
Definitely. Awesome. So we've gotten a bunch of macro talk in there, and I won't lie to you, markets. This is not my area of expertise. So I'm really thankful we were able to have you on here and talk a bunch more about it. Is there any questions or that you think I missed that I should have asked you?
No, I mean, I think you're doing a great job as a host, and the conversations are flowing. We've got a lot of great people here, so and there's no shortage of topics to talk about. What a week it's been!
Craziness, nonstop craziness. Wish it was craziness that led to a green market, but here we are. I see we were just joined by Stock Talk Weekly up here. Always a pleasure when we're able to have you on these spaces. Stock Talk, how we doing?
Doing good, man. Doing good. I was just doing a bit of house cleaning today. Have some stuff this weekend to do. Have some friends coming over, so a little bit of a housekeeping day, but good day of trading. Just happened to identify some plays that really worked today despite the chop. GoDaddy was one of them. 3 billion share buyback on a 12 billion cap. Plus, I think 4 analyst upgrades. plus a nice earnings beat. So coming into today, I figured, the beauty about, this market is that the catalyst runners tend to work because people are looking for an excuse to buy or trade stocks in the short term because of the instability in so many other individual equities. So, I've been waking up every morning in pre-market. For the people that are at Discord, they know this, 3 or 4 a.m. every day. I'll be posting things that I see with regard to volume inflow. So if I see unusual volume at pre-market open, that's usually a really good indicator of a stock that's going to continue into the regular session. Because typically when you're up at pre-market open, nothing's moving. You have no volume on the majority of stocks. And when you do see stocks that are getting hits really early like that, go and look at the pre-market volume for those stocks over the course of either a 1 month or a 3 month time frame, and you can compare the relative pre-market volume to whatever stock you're looking at. And if you deem it significant, in the early hours, it's probably a pretty good candidate for a continuation into the regular session. The reason this happens is because of the competitiveness of the level 2 spread. So, in pre-market, there's obviously not as much volume. So there's a wider bid-ask spread, and there's less competition on the bid-ask. So, you can see those big gap ups and gap downs and really choppy action in pre-market. But, if you pay enough attention to level 2 and whether you're seeing bids retreating or asks retreating, obviously bids retreating is bearish, asks retreating is bullish. If you see that happening, you can expect continuation of regular session. We saw that with GoDaddy early, went in, looked at the catalysts on the table. I like to call it a catalyst trifecta when you have an ER beat, analyst upgrades, and a buyback all together. Worked out well. It was a nice, really good relative strength runner today. Also looked into the weed pot industry, I guess you could call it. For today, Schumer last night tweeted that he's interested in another federal legalization bill. Figured it would draw volume. It did. We got hits on those plays: LFLY, SNDL, Tilray, Hitty. They all ran. And then also DD Short, which we picked up today based on obviously a lot of bad news for DD Global in general over the last few months. But 10 cent this morning, it's like 4 a.m. when it hit the wires. They said that they haven't purchased a single share of DD since the US IPO. I thought that was a huge, red flag that shows that they don't really have a lot of faith in acquiring additional equity in the company. And I figured that would cause a big drawdown move. It did. We got a dump literally right at open. And again, the reason you can expect these continuation gappers from pre-market into open is because that sparse level 2 competition that you see in pre-market instantly becomes more competitive at open. So very often what you see is either a mispricing or the bid and the ask side don't know which direction to go in. So you see either these big gap ups or big gap downs at market open on some of these pre-market runners. And again, if you have the signs, the volume on your side, the catalyst on your side, the chance that you'll see a big gap up at open, or if you're playing short, a big gap down, is a lot higher. So, we got those gaps at open. The pre-market action, obviously, some of these stocks were up a few percent, down a few percent. As soon as the regular session opened, that few percent went to double digits on both sides, and gave us some nice trades. So, yeah, really nice day of trading. I didn't make a ton of trades, but the ones we did were all hits. So, yeah, nice to see. Obviously, my long-term portfolio was not loving the end of the day when we got when we got some of that news about U.S. intelligence sources saying that Russia is preparing an invasion. Obviously, we've heard similar chatter over the last few weeks, so we'll see if it actually pans out to anything. But yeah, we got a really mean flush at the end of the session, but this morning was great.
I want to dig in and ask an extra question there. I know we've talked about what level 2 data is, and I know a lot of the traders in here will know it. But quickly, just can you explain to us a little bit about what level 2 data is and maybe how you use it or whatever good in there? And I did also have kind of a follow-up question. You talk a lot about pre-market trade. I want to know, do you ever like post-market or after hours, or is it just too many people up at that time?
I don't like after hours as much because it's not as telling. It tends to be like a tapering off of the action you see in the regular session. You obviously do have after hours runners occasionally. You have a lot more when liquidity is like pouring over the brim like we had in 2020 and 2021. don't see as many after-hour runners now. I mean, unless you're talking about earnings beats. But level two is the simplest way to put it, just a list of the bids and the asks, and it kind of shows you, the spread between the bid and ask, shows you how the asks are moving versus the bids. And immediately when you're a new trader and you look at level two, you're not going to see anything really. You're not going to notice how to use it. And the truth is, in the regular session, if you're dealing with highly liquid names, like some of these mega caps that are seeing, millions of dollars traded every 20 minutes, those names, it's a lot harder to find useful deductions from the level two data. It's a lot easier to do it. You have a little bit of a wider bid ask spread. That's why I tend to rely on it more so in pre-market. In pre-market, it's a lot more useful because the bids and asks are coming in slower. They move slower. The spreads shift, more slowly, and so it's easier to capitalize on the changes in the level two. But it's really an art more than a science to use level two to trade. Like I said, in the regular session, it's the usefulness is a lot more limited, depending on how liquid the name is that you're trading. But in pre-market, it works really well. Like, for me, I like to get a few scalps off in pre-market before I start the day. Just a positive note to start the day on. They might not be massive winners, but if I can get a few 3 to 10% scalps in pre-market, sometimes you can't get the size you want, obviously, because there's not enough volume. But I enjoy doing that. It's part of the early bird gets the worm theory for me. Not only do I see news earlier than most people when I'm up that early, but I'm able to trade some of these names while there isn't really a ton of eyes on them. And then if I, think that they're a good candidate for continuation, then I'll long them into the open, like I did with GoDaddy today, which worked out. Same thing with DD Global, went short right at the open. So it depends on what you're seeing, but that's the simplest way to put it. If you're a newer trader, it's not something I would laser focus on. If you're somebody that's more experienced and you're interested in learning how to scalp in pre-market or trade pre-market, it's something I would look into.
And obviously, in pre-market options aren't trading, but you're talking a little bit, but like you took positions when they opened. You're trading all in equities, or are we doing any options or anything like that too?
You can't buy options in pre-market, so I mean, you can get equity, but a lot of times what I'll do is if I don't want to go outright short on the equity, then in pre-market open, market open, if I think there's a good candidate for a gap down, again, I typically do not get options contracts within the first hour of the session because you see such a massive inflow of volume, and it can mess with the IV. And so I typically don't do that. But if I think there's a really good candidate like today with DD for a market open gap down, then I will grab puts at open, which I did with DD. But it really depends on what you think is going to happen. And I'm not always right. There's times where I think a stock's going to gap down at open and it gaps up, or vice versa. But it's pretty consistent. I've been pre-market trading for a long time, and so I kind of get the way it works. And I've gone through my fair share of mistakes to teach me which stocks to trade coming out of pre-market and which ones not to. So typically when you think a stock is going to be really impacted by an influx of volume, the one thing you can count on at market open is that the volume, whatever it was in pre-market, is going to become very quickly much higher. You'll see a lot of stocks where the volume will instantly double at market open or more from what it was trading at in pre-market. So it really depends. There's people that just don't trade in pre-market, and there's people that only are going to place trades when the regular session opens, especially like, I'm not saying funds don't trade pre-market because they can and do, but when you see big money coming in during the regular session, that can really like completely alter the course of the price action.
Stock Talk, I'm gonna put you on the spot here, but I'm thinking as you're talking, maybe one of these days we got to do a little bit of like a pre-market scalping spaces, kind of a live trading in the pre-market, or see what we got going there. I think obviously we got to
I'd
get a
love that. I
tour
don't know how many
for
people would
most
be up
people.
at 3 a.m., but I'd love to do
Exactly.
that.
I'm down to get up one day for it, or maybe not go to bed. But yeah, perfect with that. Big shout out to Stock Talk Weekly. If you enjoy that, definitely make sure you're following him for some cool 3 a.m. potential spaces coming soon. But already he's doing Spaces every single Sunday at 8 p.m., which is top class. I love that one. Posting a lot of amazing stuff to his feed, and he's always coming into all of our spaces and everyone's space on FinTwit. One of the must follows on here. I'm a big fan of Stock Talk. With that, I'm going to keep us rolling around. We're going to be live for a little bit more, like 15 to 30 minutes. I'm going to throw it over to Markets and Mayhem. We're DMing a little bit, or he's DMing me and talking about a point that he wants to bring up. I got Jay up here from Special Sits. I know, energy and gas and financials and a lot of the topics that are in right now are areas of focus for him. So we'll love to hear his thoughts on that, and we'll kind of roll us around and see where we get to at that. Before I do throw it over to Markets and Mayhem, I do just want to say one more time, make sure you're checking out all the speakers that we have up here. I DM'd everyone who came in here and up here. I actually didn't talk with Jay on this one, but we have him on a bunch of these spaces. So someone that I know is really, really smart and knows what he's talking about. The point is, if they're up here, that means I have faith in them and trust that these are really smart people that you want to be taking your information from. They've earned it on this call. They're really geniuses. So as you're listening to them and you like what they're saying, it's much harder to sound smart on spaces than on your timeline. So if they're in here, sound smart on spaces, I really think that is more than enough to deserve your follow and earn your follow. So click into our profiles. That was a really long-winded way of saying just follow all my speakers up here. But with that, I'm going to throw it over to Markets and Mayhem for the topic you want to talk about.
Sure, and thanks for that ringing endorsement. Really appreciate it. Feel the same about you too. Everyone here should be giving you a follow as well. You put a lot of effort into hosting these. So does Wolf. So everyone give everyone on the panel a follow. They're all great people. I know them all. And in terms of what I wanted to talk about was just a little bit of a red flag I saw on Wednesday that I wanted to share, because I think you guys might be able to use this if you're out there listening and you're not aware of it already. I like to look at equity put call ratios. I like to look at it intraday on CBOE's website, but then stock charts also, you can chart it out on a daily after the close basis by using CPCE, $CPCE. And one of the charts I just posted, and I had a little bit of a narrative on my feed, is just talking about how this was a warning sign because a lot of the really popular stocks, the FinTwit favorites, were running hard on Wednesday, and it was through a lot of near to the money, close to expiration, sort of delta squeeze call buying. And that to me is a warning sign. It's not what you want to see, especially when you see these sort of extremes. And the put call ratio on Wednesday was 0.44, which to me registered as an extreme. So I did put that tweet out there. I wanted to kind of warn people I was seeing that. But I wanted to speak more about it too, because this is a market that is really driven much more by options across the board. Last year, there was 50% more volume in options than shares. And while retail isn't all of that, they're a big chunk of it. And retail is participating in this market more now than they really ever have before. And we set a lot of records last year in terms of call premium paid, in terms of put premium sold on equities by retail. In fact, those two records were set in February and November, and what came next was not very good for a lot of those same shares that were getting bid up by those inordinate amounts of premium paid. And I mean, we can think of stocks like Upstart, Cloudflare, Asana, Affirm that really benefited from the way up. It left this very weak price structure behind, and as a result, on the way down, when those premiums weren't coming in, near term, you have market makers that are reducing their hedges because of theta decay and erosion of volatility, and also you have folks that are getting out because the price is declining, and that kind of precipitated this really meaningful decline across some of those beneficiaries, where a lot of those gaps made to the upside were filled to the downside. They were precarious on the way up, and they fell very rapidly on the way down. And as someone who does look at charts and some of these levels, I can tell you a lot of the time declines don't tend to be that violent if there wasn't that sort of violence on the upside. Like parabolic appreciation in price is often met by very violent declines. So, when you see those kind of warning signs, last year it could go on for weeks or months. This year it's very sporadic, and it really only happens on days where there's like a constructive tape. So, most of Wednesday and a portion of Thursday, you had those kind of flows coming in, and they were coming into names like Affirm, which, we saw what happened on Wednesday when it went the other way. So it's just a cautionary tale because you have less liquidity in this market. If you look at the S&P order book, it's actually about as liquid as it was during the 2020 correction. There's a strong correlation with lower amounts of liquidity and higher amounts of volatility. And then you also have more and more participants playing the market with options. So they're using leverage. They're focused on shorter time horizons, and that further exacerbates volatility. And those things are what really drive the sort of leptokurtic distribution of fat tail risk, which is to say that buyers or sellers at the index level or individual share share level by using so much leverage through options can really move things one way or another way to the extreme. And that's something that we've seen play out time and time again this year and really late last year, now even increasingly at the index level. So, when you see those extremes in sentiment, when you see retail piling into the favorites, when you see the put call ratio dropping below, 0.5 on equity, just be a little bit cautious. At least that's my tact, because that was a big warning sign. We just had a lot of things going on that seemed like people were just getting a little bit too quick on the buy the dip impulse. And I don't necessarily mean that, they were wrong. If they were trading it very short term, they might have made a lot of money, but you got to be careful with trading in this environment. Things are moving faster and they're moving farther. And it has everything to do with what I was just talking about, that lower amount of liquidity and that increased leverage with shorter time horizons.
So you talked a little bit earlier when we were first talking that in general you were taking smaller position sizes, shorter positions, everything like that. Is there anything else you want to add on top of it, like ways that traders and investors can really get in this market and be successful with that environment you're saying?
Well, I mean, for what you're mentioning, traders and investors are going to have very different approaches to the market, right? So, like, if you're a trader, you're probably trading in a day trade or intraday time frame, or you're trading, in a swing time frame. And so, for a day trading time frame, this is just a market to just sort of play these ranges. So the volatility has been generous. The price action, even though it's been very extreme, has been somewhat clinical with the levels that we're catching on the up and down side. So, if you're a technical driven trader, you're probably doing pretty well trading the S&P in this market, because it's been pretty technical. In terms of swing traders, I was mentioning earlier, I like to look for smooth uptrends to get involved with. So I've been long agriculture, I've been long Brazil. Those are two kind of smooth uptrends, like DBA, EWZ. Those are two areas to potentially look at. As an investor, I continue to look at some of my positions and hedge them with either puts or put spreads, depending on what the volatility looks like in the term structure and whether there's opportunities to, mindfully increase or decrease my debit if it makes sense. But, I'm of the mind that short term, I mean, that's where I'm doing most of my activity. That's where I'm making pretty darn good returns short term. This is a trader's market, and it's increasingly also for investors and even like swing traders. It's a stock and asset class pickers market. You can't just blindly allocate. You have to be very discerning what you allocate into, what your level of risk tolerance is, and then what your time frame is going to be for that. And defining all that in advance matters now more than ever before. It's always mattered, but you could get away with sloppy trading and investing before. In this market, it's very unforgiving if you are not going in with a plan.
Love that sentiment. Love it. Markets Mayhem. It's been a fantastic pleasure having you on. I've said this a couple times. Definitely going to get you on a bunch more of these. Big shout out to you. Make sure you're checking him out and give him a follow if you're in the crowd. Big shout out to Alex for coming up here at Stocks Cast, tweeting out the spaces as well. I already was in the DMs with him. I know we're a little bit short for time on this one. He will definitely be on the next version of the spaces next week. We'll give him a chance to talk a little bit after in a second. But I know we have Jay up here who maybe some of the themes and topics that have been really front and center recently seem like a lot of the areas you like to play and trade in. So, Jay, we'd love to hear your thoughts on this past week in the market, and maybe even would love to hear your direct thoughts on the environment today and maybe the Fed as well.
Sure, absolutely. Well, thanks for having me on. Definitely give everyone on this panel a follow. You're very kind and intelligent people on the panel, and Wolf and Stock Market News always hold these, for free, for everyone's benefit. And I can tell you, with now almost 30 hedge funds on my distribution, the information you're getting is institutional level with a lot of these sessions. So, what we're seeing right now is not only volatility in the equity market, which is likely to continue. You're seeing volatility in fixed income markets and in credit markets. So, you had earlier in the week, you had a 3-year bond auction. So the Treasury often auctions bonds as it's taking in capital. And you had a 10-year bond auction, which were absolutely wonderful. The 10-year bond auction actually was so good, was done in a way that 77% of the buyers were foreign buyers of US Treasuries. It came in 2 bips tighter than the when issued, and it was the bid to cover ratio was 2.68. What happened the following day was a 30-year auction. After, Bullard spoke and really spooked the market with his favoring of 50 bips hike in March, which I frankly don't think, could happen. everything is a possibility, but I don't think they're going to do 50 bips in March. After he said that, 30-year bond auction was pretty terrible. And that really got the market spooked. And then today, in midday, you had Gunlock, who, is basically our closest oracle. He runs Double Line Capital Management. I think 60 billion in AUM, started it from scratch after leaving his former firm. He's been pretty good at calling rates, mortgage-backed securities, high yield, collateralized loan obligations, as well as, the leveraged loan markets. And, what he was saying is, if you look at the twos, tens, the spread between the 2-year treasury and the 10-year treasury, or the fives, 30s, which is what the Fed looks at, you're really looking at the spread, or the difference between those in the yield curve, under 50 bips, which is kind of forecasting a recession in 2023. Now, is it an exact indicator? No. But that's what fixed income guys look at when they're thinking about, what's the outlook for a slowing economy in 2023. And I think that scared a lot of people. It was almost ironic the way he was speaking. He was like he doesn't own any EM equities, but he was pseudo bullish EM equities because they're so much cheaper than the US by a factor, of like, 30 to 50%. But we can talk about that at another time. I think that really scared some institutional managers who follow him in the fixed income credit markets. And you're seeing, high yield credit risk gap out. So you have $1 trillion high yield bond market where leveraged companies issue bonds. You have $1.3 trillion leveraged loan market. The leveraged loan market is a floating rate market, and the high yield bond market is a fixed rate market. And the OAS spread, the option adjusted spread, which is the risk premium in the high yield bond market, has been gapping out for the first time in a very long time. And you can look at it as an individual investor, JNK and HYG. Look at the price movements, and they're literally been going down in a straight line. And some of that's rates, some of that's spreads. So things to keep in mind are, in 2018, the Fed needed that to gap out a couple hundred basis points, which is another, 10, 15% on those ETFs before they backed out. And they backed out because high yield spreads are a forward risk indicator for unemployment, because the risk spread is essentially the probability of default divided by the number of years the bond has left minus the recovery rate. So if you think about the risk spread as being a probability of default indicator, when companies default, they lay off people. And that's part of the Fed's dual mandate. They don't want to lay off people, right? So if the high yield spreads really do gap out, that's your indication that the Fed will bring things back. But another thing to keep in mind this week was, there was a huge blowout in FX as well. If you look at the euro versus the dollar since last week, since Lagarde spoke, and we went from a world with negative interest rates, NER they called it, with $17 trillion of negative interest rate bonds all around the world, to today only $6 trillion. And if you look right before Lagarde's speech last week and the day after that speech, we went from 8.5 trillion of negative interest rate debt to 6.5 trillion as German real rates spiked. So it's not only the US, you're seeing European risk spreads in the European crossover high yield market really gapping out. And this, the risk is that, equities haven't really caught up to the credit markets, in that, prior to today's sell-off, S&P was only down 6.5%. So what does that mean? That doesn't mean things are over in this type of environment. There are assets to do well in, ag commodities, like Marcus Mayhem was saying. In energy, like I was long hugely last year, less so this year because of all the geopolitical risk already priced into the market. And if you think about, the market overall, event-driven special situations have been a great way to make money in this environment. I mean, just today, Centerbridge announced a 5% stake in Cedar Fair. So I've been big in recovery plays. So recovery plays are names alongside travel, leisure, lodging that will benefit, like Airbnb, Booking.com, Dufree, concession stands, airlines with very, very low leverage, although I have no position in airlines right now. Those names will do well because people don't want to be at home anymore, and you'll see an influx, probably travel like you haven't seen in 3 years this spring and summer. And names correlated with that are amusement parks. So Cedar Fair is an amusement park, ticker FUN, and Centerbridge took a 5% stake after SeaWorld bid $60 a share, 3.5-ish billion for the amusement park. And essentially, there are a bunch of rumors that there will be a bidding war for those assets. So you essentially have a floor of 60 where SeaWorld bid, and so you only have $2 of downside, and you have reasonable upside of 10-15%. So there are ways to play special situations like that. There are ways to play a lot of float unlocks that have been performing really well, like Matter. I don't know how many FinTwit gurus were long Matter 200-300% higher than it is now, but it was one of the easiest shorts that we've seen. It's been on our distribution list. We've talked about it openly on Spaces. So there's so much to do right now in the market, and it's important. The most important thing is to have cash on the sidelines, because if you look at what I posted above, third one in, SPAC warrants, for example, we have almost no exposure on the warrant side except for a couple pre-DAs. They're down 80%, 80% from February of last year. Now, if you had been 100% loaded in speculative asset classes like growth stocks, SPAC warrants, OTC, crypto, it's very likely that your portfolio is down 70-80% because you were long factor exposures without hedging or having any cash. Some of those opportunities, there will be 5-10 bagger opportunities in a lot of the names that have sold off. I was talking, Jessica Blamsky's in the audience today. She mentioned the name flowers.com. Flowers.com has sold off a material amount. Management was selling 100% higher. It's trading at a single-digit EBITDA multiple, and it's suffering from supply chain freight issues, which are temporary. That stock could be up 50% next year, right? It doesn't mean it can't go lower now, but there are going to be a lot of opportunities that have been created because people have been over levered. And the buy the dip mentality is the reason why I think we haven't bottomed yet. Because every day, like we were saying, Markets was saying earlier, you have someone calling the end of it all. And so, you have huge buying of call options. On Wednesday, you had one of the biggest inflows into ARK. I think 800 million of inflows into ARK. And I literally upped my SARK position that day, published it publicly. Everyone could see it. And people were saying, well, growth is bottom. And I was like, what data are you using to determine that, right? People use data, but their data is saying, oh, my portfolio is down 50%. That means things have bottomed. Completely, irrational type of logic. I get so many DMs every day. Hey, my portfolio is down, or this is down 60%, this is down 70%. That means it must be a buy. And it's not only individual investors, it's institutional investors on my hedge fund distribution list. And they'll say, well, this tech company's down XYZ. And some of these hedge fund guys are like 29 years old, right? They've never seen a cycle. They were still kids, right, during 2008. And we're not even seeing that. Even a 20% S&P decline from here is going to mean 3-4 times multiple, 3-4x multiple compression for even like the average industrial name, right? So think about the type of risk you're taking in this environment, and how, whether you're prepared or if you're okay with another drawdown from here before buying the dip aggressively in some of these names. So I don't want to take a lot of time. I know that we also have some Ukraine news that I'd be happy to talk about, but wanted to take a break here and see if you had any questions.
Yeah, Jay, I appreciate you as always. We're definitely right in your wheelhouse, so love to hear your thoughts and a lot of insightful thoughts at that. We are getting to the end of the space, and I definitely want to make sure Alex has a chance to talk. So I think that I would actually, if you want to give any insights or any thoughts on the Russia-Ukraine situation, we could do that. Then I'll throw it over to Alex Stock from the Stockcast to give us a couple quick thoughts there as well, and then we'll throw it around into wrap ups. So. Yeah, Jay. Well, what's your quick thoughts on the Russia-Ukraine situation? Obviously, it's a long story to unpacked, but yeah.
Oh yeah, absolutely. It's a very, very long story, multi-year story, but 5 seconds on it. Today we had PBS, which is speaking with, someone within the White House, mentioned that Russia could potentially enter Ukraine. Now, it's not going to result in a war. I think part of what I want to do is explain that people take things too far on FinTwit. They either go too bearish or too bullish. It doesn't mean there's going to be a world war, but there are 130,000 troops around the borders of Belarus and the Ukraine. And, there are some rumors that within the next week, if you were listening to the White House press briefing, there are some biases here. So it's not a guarantee that Ukraine could be, Russia could enter Ukraine. That resulted in intraday moves of crude oil about 4 or 5% to the upside. That kind of tapered to 3.5% after the press briefing. But it really resulted in the NASDAQ. The first kind of break in the NASDAQ was the Gunlock interview on CNBC, where I haven't seen him this bearish in a long time. And then the second crack was this PBS. By the way, no other mainstream media was talking about this, and Bloomberg was 35 minutes late. So you guys who use Bloomberg, Bloomberg's not the best when it comes to some of these things. Twitter actually was faster and Data was faster. But essentially, next week, everyone had the assumption that because of the Olympics in China, because Xi and Putin are tight, that Putin wouldn't risk entering Ukraine prior to the Olympics. And, I'm not one to judge or say, but we must have some people either in Ukraine or in Russia, but somehow the US government thinks that it's a possibility. If it's a nothing burger, there could be a risk up move from here, like a pop at a relief rally. But if something does happen, next week, it's something to keep in mind. They don't go all in, before a geopolitical event like that, because even if it's short term, there could be, a risk spike associated with that. In Germany, right? The reason why I don't think it's going to escalate into a bigger war is that Germany really gets 40%, that's 40% of their energy from Russia. And, Germany is part of NATO, but they have been much less vocal about what's going on. It's really been a Biden agenda. And if you talk to individuals in Ukraine, like I have a friend of a developer who lives in Ukraine, there's some people who in Kiev are very stressed about it, and some who are like, I have no idea what you're talking about. So, it's kind of a binary event to just keep on the radar.
Awesome, Jay. I appreciate that. I'm excited. I don't know if excited is the word that I would use here this one, but I will definitely be watching this one as we go forward. Definitely one of the main things the market is watching going forward. So definitely appreciate your takes there, Jay. Always a pleasure to have on these spaces. Make sure you're checking out Jay and all the other speakers we have up here, and I'm gonna let and bring Alex into this and hear some of your thoughts on the week and how you were doing.
I appreciate it. And I want to say shout out to everyone that's up here from Stock Talk Weekly, Markets Mayhems, Jay, Bullish, all you guys. You guys are doing a great job. I love what you guys are doing, bringing together FinTwit and those that are actually trying to educate the followers. So I really appreciate what you guys are doing. So from everyone that spoke, there's really nothing I can really add on to it because you guys have all hit really on the head. There is an aspect when you're coming into your investments. I'm predominantly a swing trader and a long-term investor. And right now you don't buy on speculation anymore. You're not buying into hype. You should not do that in any shape or form. You have to be very careful in your investments. Just like we saw today, there's things that are dropping 20%, like large caps are moving like penny stocks. So right now, especially with that geopolitical event happening potentially, you could be proactive in this. I did post today, like if you wanted to invest into something that's still recovering but could potentially see a pop, is investing into like defense and aerospace. We know like there's one ETF that's somewhat bullish in this, is a DFEN. I think that's being kind of positioning yourself that would actually make some money and actually generate a little bit more revenue. If there was a big geopolitical event that would come off of this, you could, but it's still very risky. If you're looking for other portions to invest into, you should be waiting and paying attention to the chart analysis, technical analysis, find those support levels, and don't force anything when it comes to trading or investing. But really nothing else to add on to it. All you guys have really hit it on the head. So I hope that you guys had a good week trading. It's been predominantly a sideways week for me, but I know that good times ahead, even though there may be a little bit of downside, but my vision is more 2 to 5 years from now.
Appreciate that, Alex. Excited to have you on. The space already confirmed for next Friday, so we can get a little bit more in depth into your thoughts. Definitely someone I've been following for a little bit on here, and excited to hear more about that. With this, I'm going to throw us over into wrap ups. Give all of our speakers up here a chance to let us know what they're doing. Let us know what they're watching for next week. Any cool things they got going for this weekend. And I'm going to throw one more thing in here. I know this is a stock spaces, but it's Super Bowl weekend. I got to know, If you guys care about football at all, any of the speakers, what team are we picking? No spread, no nothing like that. Just who's going to win the game. Would definitely love to hear you guys' thoughts there. Quickly, I have no problems with being annoying to people, and I know I've said this like 10 times here, but I'm going to say it more. All the speakers come in here. They're really, really smart people. Come in here for free and share a lot of invaluable information, that you can't really find anywhere else. So, just as these people are up here, as they're speaking, make sure you click into their profiles, check them out, check out what they're doing. When you're on Spaces and you're talking and you're not behind a computer screen, there really is no way to fake that you know what you're doing. It's either you can hear as they're talking that people are very knowledgeable and have a lot of information to share. So, when their timeline's in there and they can sit down and think about it, it's only going to be that much better. But, just going forward, as you're listening to people talk up here, just know that, speaking in front of people, speaking about this stuff, it is not easy. And anyone who can come up here and really prove that they know what they're doing, to me, that's enough to earn their follow there, and we can go from there. But with that, I'm going to throw us and slide us over into wrap-ups. Brad, it's been a little too long since we've heard from you. I say this a bunch of times, more Brad is good on a Spaces. I want to start out with you.
Yeah, and the feeling's definitely mutual, Evan. But Super Bowl weekend. Honestly, I'm more focused on, and I'm probably the only one in this entire chat who's more focused on it. But Michigan's playing Ohio State in basketball on Saturday. I mean, if we get that win, another step in the right direction and dancing in March. But from a wrap up perspective, I guess I'll just tell everyone in here what I'll be posting tomorrow. So the news of the week post that comes out every Saturday. It's going to have a KBRA, or a Kroll Bond Rating Agency, surveillance report on Upstart. It's going to have some more information on SoFi and a new partner that they just landed for Galileo, which is their B2B payment processing software branch that has clients like Robinhood and Chime. But enough about them. A lot of information about JFrog's quarter that they just had. Thank you for having me as always. Go Blue for Saturday. And looking forward to doing a lot more of these in the future.
I want to come in and compliment you, but after we say "Go Blue" multiple times, I don't know if I can as a Ohio State alumni, but I'll come in. Big shout out to Brad. He's a very smart guy. He knows exactly what he's doing, and big shout out to his free Substack. He's throwing out so much information there, and it is all free. Click into his profile, and you'll be getting smarter each and every single week. So definitely something I would recommend to throw behind that. I will keep us moving and throw it over to Markets and Mayhem for your wrap ups, what we're looking at next week, and maybe anything else you got going on the Twitter account or on the back end. Oh, also the Super Bowl pick. Got to keep reminding that. Can't forget. Oh, I see you unmuted, but I don't think I can hear you.
Oh, sorry about that. So I don't really have a pick in the Super Bowl. Not really my cup of tea, so to speak. But Evan, I really appreciate you having me on, and I can speak to a little bit of what I'm going to be watching over the weekend and into next week. So, of course, Ukraine's going to have everyone's attention over the weekend. I'll also be watching crypto just a little bit as a proxy for liquidity and sentiment. As we get into next week, I'm going to be watching some levels on the S&P. The three main levels I'm watching are 4,400, 4,280, and 4,212. Hopefully, we don't get to that lower level, but that is the lows that we explored in the tail end of January. And if that breaks, then I'm going to be pretty concerned. We have a pretty packed economic calendar next week because we have a combination of Fed speakers, including our favorite Bullard, as well as PPI, retail, and FOMC minutes are going to be coming out on Wednesday. So I think that's going to be pretty important to watch. I'll also be looking at bonds, credit markets, in particular the yield curve, high yield spreads, and the MOVE index, which tracks volatility in the bond market, sort of like the VIX for the bond market. And I'll be watching Ukraine into next week as well. So those are the kind of key things that I'll be keeping my eye on. I think that we have some potential for follow-through selling to continue into Monday. Friday to Monday selling is not too uncommon, but we do want to definitely see how some of these key levels are defended. From a technical standpoint, I know we can say that technical analysis is astrology for gamblers, and there's some truth to that, but we did paint a head and shoulders, pattern on the S&P. So whether or not that manifests from, voodoo or not, or whether we start to see some kind of turnaround in price is going to be pretty key, I think, by Tuesday. So those are kind of what I have my eye on going into next week. And I want to just thank everyone on the panel. You guys are all awesome. This has been great doing this with you all. Hope to do it again. And also want to shout out everyone in the audience for listening in and just show my appreciation. Hope you have a great weekend.
Mayhem, what's the link in your bio, the trader raid thing? I see it's also your pinned tweet. What we got going on there?
Sure. Yeah. Thanks for the opportunity to discuss that. So, Trader 8 is a collaboration between myself and Misha Gandolf, you might know as Horse. And our goal is to try to help retail. It's by retail for retail. So, we're really trying to help traders and investors. So, we provide, digests of macro information, potential actionable plays, analysis of what's going on in the market. We do it in several formats: audio, video, and text. We also have, Horse has a really great day trading course that helps people learn more about how to play the sort of trading the futures side of the markets. If you're looking at the S&P 500, for example, and the Nasdaq, quite frankly. But then also I offer coaching or one-on-one. So I'm trying to help people learn more about trading and investing, especially as it concerns enhancing their strengths, dealing with any weaknesses that they might have, coming up with better plans and strategies so that they can become more consistent at executing, better at managing their risk, coming in with plans, sort of some of the concepts we talked about tonight, and also teaching about some of the areas that are, often weak spots for retail traders and investors. And it's nothing against them. I mean, macro has always mattered, as Jay says, but a lot of people never learned about it because it didn't matter for price discovery for a long time. And now it really, really, really matters. And so I'm also helping people learn more about macro, more about fundamentals, more about technicals, try to bring the whole picture together so they can come into these trading and investment plans with more conviction and a better sense as to, what their risk is and what their reward might be. And, basically try to improve outcomes over time. So Trader 8 is a multifaceted offering. It's got that subscription service, it's got the hourly coaching, and it's got the sort of 27 video course on day trading as well.
Awesome, love it. Everyone definitely in the crowd should go in and check that out. At a minimum, you got to be going in and clicking into everyone's profile, hitting that follow button, and seeing what they're doing. I think pretty much everyone up here is going to have a service on the back end or something that they're going to be doing. And they're really, really smart people. Their time is not going to be free. But there's there's going to be a lot of amazing and free information on their Twitter pages. And yeah, so when you want to take that extra mile for the right person, a lot of these products are right for you. But what is right for everyone, and I can confidently say that, is just checking out all these profiles, hitting that follow button, clicking them out, and checking them out. And yeah, but with that, I'm going to keep us sliding and throw it over to our next person for wrap up, who's also got a really, really amazing product that I would love to hear. Stock Talk. Would love to hear a little bit about your Discord. I know you were talking about some spring cleaning going on in the background. We got a nice Super Bowl party coming. Who we picking?
I mean, I don't want to say that the Bengals are a better team than the Rams, but I like the story. I like Burrow. I'm gonna hope that the Bengals win, but we'll see. For me, yeah, I mean, today was great. My Discord, it is a pretty affordable place to just find a community to trade with. Charge $20 a month, which I think is affordable for most people. I hope. A lot of these rooms are charging $100, $200 a month, which I didn't really find that to be practical when I started mine, because a lot of the people who need help have smaller accounts or are newer traders. So I think pricing it at that point would cut out a lot of the people that genuinely do need help. But it's really just a place for education. We have trade desks. We have swing trade alert rooms, day trade alert rooms. We have AI news. We have trading bots that monitor flow. We have Unusual Whales bot in there, Trade Ticks bot. We have a number of contributors that are there to answer questions 24/7, including myself. And so it's a really good place for somebody who's a new trader who's looking for a little bit more help. And obviously, you can cancel at any time. There's no obligations. There's no lifetime memberships or yearly packages. It's just very simple Discord, $20 a month. And the only reason we're really charging for it is so that it doesn't become this community full of 100,000 people that is just, we're not able to provide individual time and attention to people, which is what we're trying to do. So for those who are interested in it, the link's in my bio. You can feel free to check it out. If not, and you don't feel like paying for a service, absolutely, completely understand. And you don't have to. There's no obligation. My tweets are obviously free, and I'll continue to tweet. But yeah, it's just a place for new traders and even experienced traders who are looking for just a community to trade with, bounce ideas off of, share trade reviews, share ideas. We have an education channel full of links and resources to teach you everything from technical analysis to fundamental analysis to how to read a balance sheet, to how to read an earnings report. So basically trying to help people hone their skills. The intention there is to teach people how to fish rather than handing out fish. We do have trade alerts, of course, but that's just part of sharing ideas, and we encourage everybody to analyze those ideas on their own. But yeah, that's what it is in a nutshell. But great week of trading. Other than that, thanks for letting me talk about that, Evan.
My pleasure. Listen, I genuinely am a fan of Stock Talk, everything he's got going. Definitely a very, very smart guy. He's on Spaces pretty much all day, it feels like. Just popping around. He should do more of his own ones, host them out, get some more of the people coming directly to you. But that's nevertheless. I know you actually might be the next Spaces that I'll be in, which will be Sunday at 8 p.m. EST. Big shout out to the Twitter account as well. A lot of really great information on there. And I guess some drama and beef as well to keep everyone on their toes and keep it exciting. But shout out to anyone who saw that. I missed it and was catching up during the Spaces, but we'll keep us moving with that.
One thing I will say about that is I have zero beef with anybody as long as you don't delete your tweets and you don't post paper trade gains. It's the only two things that bother me.
Penny stock pumpers too. There's a good one. There's a couple. We got a wide range of people doing questionable things on FinTwit. So always nice having someone call them out. But yeah, big shout out to that. And I'll keep us moving and throw it over to Jay for us.
Hey, for when it comes to the Super Bowl, I think the Rams may take it, but I think they're bringing the boomers back. I think for those who are on the Spaces who care more about the halftime show, I think you're going to have Kendrick Lamar, Dr. Dre, Snoop Dogg performing at the halftime show, so that should be fun as well.
You just left out Eminem, really?
And Eminem, of course Eminem. I'm doing this all from memory, and I'm older, so excuse that.
No, you're good.
So, yeah, I think this coming week, from an earnings calendar perspective as well, is just going to be insane, right? You're going to have Carr, Avis reporting. You're going to have Spirit Realty. You're going to have Vornado Realty. You're going to have a number of different REITs. You're going to have Airbnb, Upstart, Angie, Viacom. You're going to have AIG, Altice, Gold, Barrick Gold, Cowen, Fisker, both longs and shorts in the list that we're watching, go both ways. There are actually going to be a number of mortgage REITs that we follow that have preferreds that can pay you 7-8% with much lower risk than the equity market, like Chimera is going to be posting on Thursday. You're going to have Invesco Mortgage Capital posting on Thursday. And, I think Friday is going to be a little bit is going to be a slow day as we get to the end of the week. But I think the Wednesday, the 16th, and Thursday, the 17th, are going to be two of the biggest earnings days of the season. So not only do we have all the macro items on the calendar, the Fed minutes, Bullard speaking, PPI, et cetera, you're going to have a huge earnings week. Get some rest this weekend after the Super Bowl so that you have the ability to be efficient next week. And guys up here, if you are, more experienced trader, or if you're an institutional trader, or aficionado of merger arbor SPACs, specialist research is the area. We cater to both individuals and institutions. So right now we have 12 family offices, 30 hedge funds, and a few hundred individual investors who not only ask questions about specific names that they're in, but also look at our coverage lists. Just this week there are 3 put spreads that returned over 100% in the SPAC space because of potential unlocks and ex redemption dates. We also are on the top of special situations names like Microsoft Activision, Cedar Fair, and have value names as well that we talk about every month, like CVS, which we recently sold out of at all-time highs, Zim, which benefited from container shipping rates, and it's up a few $100 from IPO, is going to potentially pay a $10 to $12.50 dividend this year. And a name that reported today, Ladder Capital, which trades at a 20% discount to book value, which means it trades at a discount to its underlying real estate loans, which are senior to the capital structure than real estate equity, and pays a 7% dividend. So as the market, Nasdaq was down 3, S&P was down almost 2%. These names have lower beta. They move like 0.5%, and pay dividends. So we try to work with, experienced traders, newer traders who don't know about special sits and institutions, and also provide a database. And we added a new portion to the database, which is optional SPACs, 168 optional SPACs where you can write covered calls, cash covered puts, and also, take directional or spread type positions in the market. So a lot of fun stuff next week. Looking forward to sharing the experiences with you, and doing in other spaces.
Definitely super excited to have you on again, Jay. As always, we got a very busy week coming up, and empirically, as a someone from New York who went to school in Ohio, I got to say Cedar Fair, a lot of their theme parks do resonate with me. Cedar Point, I've been to a couple times, Dorney Park, Kings Island. So I know that's not a stock a lot of people might care about or know, but definitely a company that I enjoy and have a positive internal opinion on. But there's a lot of those type companies in there that no one really cares about the stock, but the
Exactly.
product is something that is kind of interesting to me.
Everyone on FinTwit either talks about highly risky stocks or the same 100 to 150 stocks. We need to get some new tickers in there.
Yeah, fair's an interesting one, and there's a couple. I'm always shocked that
I'm
like
gonna start tweeting about REITs just for you, Jay.
Awesome, man.
We'll just throw in the
You guys
REIT
laugh, but I was
No, I
long
wasn't kidding.
digital realty during COVID. It was a 400% unlevered return on the common, and if you were in options, it could have been a 2,000% return. And I was even buying prefs, like $12 prefs, paying 25% current cash, right? That had an over a 200% return. So, I mean, knowing these names when shit hits the fan, like you can take risk, you can put millions of dollars into these names and not worry because the cash on cash is so high.
Jay, I own one REIT. I want to get the quick initial reaction on it. I know we're deep into wrap ups, but NRZ, new residential investment.
So NRZ actually is an interesting name because it also has an MSR, which is a mortgage servicing right. So I actually like NRZ. It has a decent dividend payout ratio. It's probably, I think it's around 10.58 today. I think it trades close to book. And I think that, if we see some market volatility, it'll probably be an ad for me. I owned it and I sold out of it in 2021. But if you look at it today, it is paying a 9.5% dividend yield. And the good thing about this dividend yield is it's a sustainable yield. Because the thing that people get in trouble with REITs is they don't do the analysis, on AFFO, and they don't understand which REITs are paying dividends that could be cut and which are paying sustainable dividends. The agency REITs could actually be cutting their dividends because of how rates are moving and how mortgage spreads are moving, because their book values will decline. REITs like NRZ have a lower probability of cutting their dividends. So that's not a bad one.
Love to hear. That's exactly what I wanted to hear from that. Perfect. Excited to have you on a bunch more spaces, Jay, next week. And yeah, I'll throw it over to Alex now for wrap ups. Based on the hands, I'm guessing we're going Rams for the Super Bowl, but let me know if I'm wrong. Although
absolutely.
I feel like I got a nice pop when we were talking Midwest, so I thought there was a small chance Cleveland, but
No,
Cincinnati. Oh my God. Okay.
I'm a Michigan guy, just like Brad, so go blue. But I'm a Detroit Lions fan through and through, and I've been always wanting Matthew Stafford to get that title. So I'm rooting for Matthew Stafford. So hopefully him and the Rams do what they need to do to win. And Matthew Stafford just really kind of deserves it. Him and his family have been through a lot, especially in Detroit. We've basically beat the shit out of him. So I hope that he does well. For wrap up for what I'm looking at, kind of what everyone has said. Again, everyone kind of takes a lot of words out of my mouth, but I'm looking at a lot of fintech, what Brad was looking at from Upstart to SoFi, looking at recovery, looking at what's coming up for them. Also looking at aerospace and defense in correlation to what's going on in Ukraine. And yeah, I like what Jay said about REITs. I think it's always good to set yourself up for some passive income with some growth aspect to it. It's kind of a no-brainer in my mind. So that's basically it for me, and we could talk a lot more next week as well.
Yes, sir. Excited to have you back on in the same spaces, same time, 4 p.m. EST. I laugh at you being a Lions fan, but I am a Jets fan, so I can't really say more in there. I have nothing to say. But I'm gonna just quickly throw out my pick. I'm gonna go with the Rams. I'm gonna say if it was against the spread, I would maybe pick the Bengals, but No spread, no nothing there. I'm going to choose the Rams. I'll keep it brief with that and throw it over to my amazing co-host to his wrap-ups, maybe a little sneak peek into some of the spaces we got going next week. And yeah, just in general, how we feeling, Wolf? What we got going on?
Feeling pretty good. Let's finish out the week with some energy for sure. We did 44 hours of spaces this week, so we're going to roll that into next week going pretty hard. I will say first Super Bowl pick. So I think we have to be a little bit technical here. So if you're looking on two different sides, one team is just clearly better than the other. The Rams are 5th in DVOA. That's weighted DVOA versus the Bengals, who are 17th. I am a Ravens fan. I have no problem with the Bengals. There's this kind of weird thing, bringing them back to my division. I like Joe Burr. I get it. He's Joe Shiesty and everything going on there, but they're kind of living on a prayer. I think you look at the problems that you have on the Bengals offensive line. It's a freaking sieve. You got Von Miller, Aaron Donald, Leonard Floyd. I don't think that's going to work out well. And then also, if anybody needs motivation, go to Stafford. Go on YouTube and look up Stafford's first season in the league. He's a rookie. There's a play. It's the end of the game. He throws the ball and just gets slammed into the ground. They have to carry the dude off the field. They have the ball at the 1 yard line. There's a timeout. It's paused, and they need a touchdown. And Stafford's on the ground just screaming in pain. And they walk over and they go okay, what do we do? We have to get to the hospital. And he goes, wait, the game's not over. I can throw the ball. And he gets up, goes back into the game on the 1 yard line. He's clutching his arm and throws a 1 yard touchdown. They win the game. Walks off. He had separated his shoulder, and it was not put back in the sideline. And he went back in with a separated shoulder and played. So I'll root for Matt Stafford for that. He's had enough. Joe Burrow will have his time. But good for them for getting to the Super Bowl, even though nobody knows who the fuck Zach Taylor is. So let's roll with that. And I will say for next week, if you want a sneak peek at all of the spaces, we have a one-of-a-kind tool. It's called our Google Spaces calendar. It's our Google calendar for Twitter Spaces. Anyways, I have it already loaded up for next week. I have about 17 of our spaces already on there. I am working on others. Of course, we have our regular slew of live trading, NFTs, crypto, everything. We also have a GameFi space with the Board Elon account, 1.7 million followers. Keep an eye out for that and a whole bunch more. If you want to be added to that calendar and join 3,500 other investors using it to find out when all of our spaces are happening, all you have to do is DM me your Gmail. That is it. I have about a dozen waiting in the DMs. I'm going to get in there afterwards. I will get to them. So just DM me your Gmail. Ask me on the calendar, completely free. Try it out for a week. If you don't like it, you can unsubscribe for free. You don't even have to message me. It just takes you right off. That's it. That's all I got. Looking forward to the Super Bowl. One thing, I will potentially be doing a space right before the Super Bowl for an hour talking gambling and betting props with the Wall Street Bulls. So if you're into degenery and you want to come, I've got some whack props that I'll be putting out there. We're going to be analyzing coin toss. We're going to be analyzing Gatorade pour. I've got all the statistics, all the history nailed down.
Wait, tell me about Gatorade pour because I don't know about that.
Okay, so at the end of the game,
it's going to be blue.
Players are going to go ahead and dump the Gatorade on. What you guys didn't know is how can they make sure nobody knows? They actually bring 3 different colors of Gatorade to the field, and then it's randomly grabbed by one of the players at the end of the game, which one they're going to dump. They actually have never
randomly.
Dumped. Yeah.
Wait, so so you have a 1/3 probability for that?
No, because there's 5 different colors.
So it's 5. Okay.
Yeah, so there's orange, there's yellow/green, there's blue, there's purple, there's clear, and then technically there's red, but they've never dumped red in history. Right now, blue is the betting favorite at plus 280, and then orange and yellow are coming in second at plus 500.
So if you bet on red, that could be like 1,000x type return.
It could be, but it's never ever happened. And this is Super Bowl 56, I'm pretty sure, 57, something like that. So it is unlikely, is what I will put it out there. There's also been times where they didn't pour. So you got to keep an eye out for all angles. I'm also going to have betting props on the over-under for the national anthem, everything. If you're degen and you want to just come and listen, I'll probably have that open on Sunday. So tune in.
Quickly, I'm going to take the over on the national anthem. It's probably going to be over. What is it going to be? They're going to say 1:30 to 1:40 seconds. That stuff's going 2 minutes 30 seconds at least.
It's actually short. So this year, I believe it's 1:05. I think I have to look it up again. It's
over.
Mickey Guyton is the woman who is singing it. Mickey Guyton. They actually call her Quickie Mickey because she sings it pretty fast. So you have to keep an eye on the time.
No, they call her Quickie Mickey?
They call her Quickie Mickey. I'm not kidding, in the betting circles.
There's no way.
There is. Look up Mickey Guyton. Go and Google it. They call her Quickie Mickey. She's singing the national anthem. You got to keep an eye out for that under. It's the line's been moving.
That
All
nickname
right,
is unfortunate.
I got a parlay here.
If you can't tell, this is like my love of my life is football gambling. So yeah, just ask.
Wolf, give me a little parlay here. I'm going to take the over on the national anthem. I'm going to take tails on the coin toss. I'm going to take blue Gatorade, and let me say that this game is going to go to overtime. So give me that parlay. Let me know the odds on that after. We'll talk about that on the spaces. Alex, I saw you unmute really quickly. We're kind of, for any of my speakers, if you actually got anything you got to do, we're really just chilling up here. The spaces may end, whatever, but I've actually enjoyed this conversation, and I'm assuming a lot of people down below have as well. But yeah, if any of you guys do have to go or anything, feel free to step off. But Alex, I did see you on mute.
No, I was just saying that name was unfortunate.
Yeah, man. It's what's happening. But to be honest, I think that they're most interesting. Here, I'll give you my most interesting bet, and I just want y'all to, I'll leave you on this and think about it. The most interesting bet that I have is that the opening kickoff will not be a touchback and will be returned. Why? If you look at most games, right, the opening kickoff, they typically kick it through, but in the Super Bowl, over 75% of the time, there is a return. And why does that happen? It's because in a majority of games, the kicker before the game is given the ball and they warm it up. They push it in and they like pump it, kind of like in baseball where they take the baseball and they mess it up so you get a feel for it. And what that does is it softens the ball a little and it lets them kick it through the end zone. That happens every game of the season, including playoffs, except in the Super Bowl. In the Super Bowl, the ball that is kicked off is put into the Hall of Fame, and they need it in pristine condition or as good as it can get. So they don't let them warm up the ball. They hand them the ball gets kicked off, returned, and then they take that ball and they send it right to the Hall of Fame. So that's the only use that ball gets. So it does not get compressed. So over 75% of the time, it does not make it to the end zone. Even last year, Harrison Butker, who has one of the strongest legs in the NFL, kicked off, tried to get it. It clearly was trying for a touchback and barely made it to the goal line, and it was returned. So just keep that one in mind.
Wolf, so actually, to add to this point, it's actually really funny. So I am genuinely a fan of Pat McAfee. So he's a pretty huge podcast or whatever you'll call him in the sports world right now, but he was a punter and kicker. He did kick off in the Super Bowl, and he literally said the exact same thing, that they gave him a brand new ball and that there is no shot he was ever getting that close to a touchback. So that is hilarious that I have literally heard the exact same thing from someone who genuinely kicked off in the Super Bowl. So what are the odds on that?
The odds are actually pretty good. I think they're like minus 130.
Listen, we're giving out stock plays. We're giving out gambling plays. Someone's got to get into what was the national anthem singer again. Someone's got to hear the warm-ups, got to get that timed. I saw that for other events in the past. I got to hear, someone's got to be there. If you're at SoFi Stadium, go out a day early and do me a favor, time the national anthem. We'll see how long it is and we'll all profit on that.
Oh, yeah. It's also a home game for the Rams, by the way. Just want to point that out for the Super Bowl. And this, by the way, them playing the stadium sets a record for most home games played by a team in a single season ever. Because they had the extra game during the season. They had home field advantage through all the playoffs, and they're doing it. They have not left California in like a month and a half or something. It's crazy. And it's in a different time zone for the Bengals, and everyone knows EST is elite, and they have to go to PST, so they are fucked.
Love it.
You know what? Honestly, Gav, I think that is a perfect way to end it. Love it there. Big shout out to all my speakers and big shout out to all the listeners. Honestly, if you're still in here, you are truly obviously a fan of us based on the conversation we've been going. 330 people. I think it's hilarious. I love this stuff. I think it's a great break, especially when it's 5:30, 6 o'clock or whatever on a Friday after a long week. I think this stuff is really refreshing. Hopefully, we maybe got someone a little bit of a winner in there for over the weekend on the Super Bowl. Obviously, always bet responsibly and only where you're allowed to. Shout out to New York for letting me do that now, and shout out to all the sports betting apps for giving me like $1 million of free promos so that I am still not betting with my own money. Shout out to that, and I think that will be solid there. Gav, is there any last points you wanted to add in there?
Yeah, if you have a gambling problem, call 1-800-GAMBLER.
You know, I was driving today and I was listening to Z100 And they actually, they had a sports betting site. I won't name it. And at the very end, they posted the betting addiction number and the website. It was pretty responsible to do that.
It's
I don't.
illegal if you don't.
Okay, well that's good to know as well.
I see it a lot on like some of like the Barstool stuff. I know their shows have it a lot, and a lot of places. Yeah, I think that's definitely what they're trying to pump out there. And I think you can even get notifications sometimes from the apps. I haven't gotten that into it where I would see that firsthand though. So, but Stock Talk also. Wait, are you still here, Stock Talk?
I am still here.
Last question, then we will actually end it here. Are you going to be doing the trade of the week play at 8 p.m. on Sunday during the Super Bowl, or are we moving it? Are we competing with the Super Bowl?
You know what? Now that I think about it, it's probably not the greatest idea.
Let's do it the next weekend.
Yeah, I think I might move it to the next weekend. That's a good point with the Super Bowl, and my girlfriend will be in town as well for Valentine's Day stuff. So it's probably best that we postpone that.
Oh, dude! So you're choosing the girlfriend over the boys for Valentine's Day? I see how it is.
It's one day a year, my guy.
Whoa, I don't think he has a choice, bro. I don't think he has a choice.
I'm busted. All right, now I think that's another perfect.
It's just that retail created holiday, Valentine's Day. They want you to buy more chocolate and teddy bears. That's just what it is.
It's smart.
It's an economy of itself, and Hershey stock not doing too bad, all things considered.
Damn, I should have got Hershey's called.
1-800-Flowers, man.
Right? Yep.
I'm surprised I don't hear more about like a Valentine's Day index coming into it, because there are totally like some random stuff that people don't really care too much about normally that seem that they could get some decent coverage.
The Valentine's Day basket trade, we could create a synthetic instrument for it.
Valentine's Day ETF. You just see the chart is like flat all year long, and then right before Valentine's Day,
we'll charge you a year of fees today.
All right, perfect. All right, so I actually really did enjoy the end of the spaces, and I'm really glad that we kind of just had some fun here at the end. Like I was saying, it's Friday, it's 6 p.m. in the superior time zone, which is EST. So it's time for these conversations. Everyone enjoy the weekend, enjoy the Super Bowl. I'm already waiting for 9:30 a.m. Eastern on Monday when the market is back open again. Hopefully green. We'll see. Not holding my breath on that, but. Yeah, everyone have a great one. Big shout out to all the listeners for coming in here, making this worth it. And yeah, big shout out to all the speakers as well. And I will see you all next week.
Have a good weekend, everyone.
Have a great weekend.
Yeah, have a great weekend. Insert 5 seconds so that here our roundup. Shout out to Wolf and Stock Talk know exactly what I'm talking about. And end.